Welcome to 2025, a pivotal year where new regulations are reshaping the cryptocurrency and DeFi landscape. You bought Bitcoin in 2021, used Uniswap last month, and staked ETH last week. But here's the hard truth. None of that exists in a legal vacuum anymore. Welcome to 2025, the year crypto finally grew up and governments around the world said, "We're taking control." For over a decade, the crypto space thrived in the shadows, decentralized, borderless, and largely unregulated. It was the wild west of finance, full of opportunity, yes, but also chaos, fraud, and catastrophic collapses. Then came FTX, Terra/Luna, and billions lost in DeFi hacks, prompting regulators everywhere to realize this can't go on. So what's actually changing? And what does it mean for you? First, the great crypto classification is finally happening. In the United States, after years of ambiguity, the SEC has drawn a clear line. Bitcoin is officially a commodity, regulated by the CFTC, much like gold or oil. But most other tokens, including Ethereum after its shift to proof of stake, are now being treated as securities. This means they fall under the same rules as stocks. They must register with the SEC, disclose risks, and ensure investor protections. This is why Coinbase and Binance are locked in billion-dollar legal battles. If your token is deemed a security and you never filed the proper paperwork, you're not just non-compliant, you're operating illegally. Second, DeFi is no longer too decentralized to regulate. Remember the early promise? Code is law. No middlemen. No gatekeepers. That sounded revolutionary until real people started losing life savings to unaudited smart contracts and rug pulls. Now, regulators are targeting not just users, but builders. In 2024, the European Union passed MiCA 2.0, requiring anyone who creates, maintains, or promotes a DeFi protocol to register as a licensed financial entity. Yes, even open source developers could be liable. The US isn't far behind. The message is clear. If your app handles money, you're responsible for it. Third, crypto exchanges must now act like traditional banks. Gone are the days of anonymous accounts and instant withdrawals with no questions asked. Under the global FATF travel rule, every crypto transaction over $1,000 must include verified sender and receiver information, just like a wire transfer. Exchanges like Kraken, Gemini, and Binance now enforce strict KYC checks, monitor transaction patterns, and report large movements to financial intelligence units. In short, your crypto activity is now as visible to authorities as your bank account. And it's not just Western nations. China banned private crypto trading, but aggressively rolled out its digital yuan, now used by over 260 million citizens. India slapped a 30% tax on all crypto gains, plus a 1% transaction levy on every trade. Even El Salvador, the first country to adopt Bitcoin as legal tender, now requires all wallet providers to verify user identities and comply with anti-money laundering rules. But here's the twist most people miss. Regulation isn't killing crypto, it's separating the serious from the scams. Legitimate projects are thriving under clear rules. Institutional investors like BlackRock, Fidelity, and Vanguard are finally entering the space. They don't want chaos. They want clarity. And now they're getting it. The result? A more stable, trustworthy ecosystem where innovation happens within guardrails, not outside them. Of course, this shift brings new challenges. Not every regulated token is safe. Not every compliant exchange is honest. And the line between innovation and overreach is still blurry. But one thing is certain, the era of move fast and break things is over. The era of build responsibly and scale securely has begun. And that brings us to your biggest risk in 2025, not from hackers or crashes, but from your own FOMO. Because while the rules are tightening, the scams are getting smarter. Fake airdrops, celebrity endorsements, guaranteed yield farms, they all look more convincing than ever. In part 2, we'll show you exactly how to spot the red flags before you lose your money to the next FTX or Squid Game token. We'll cover real strategies to manage volatility, avoid scams, and protect your digital wealth in a world where trust must be earned, not assumed. Stay with me.
Hello and welcome. Today, we're diving deep into cryptocurrency to discuss how you can protect yourself from its inherent volatility and the ever-present threat of scams. Let's be honest, crypto isn't just volatile. It's a psychological battlefield. Every day, you're bombarded with hype. You hear things like, Elon just tweeted a dog by now. But behind all the glitter, often, there's nothing but smoke, mirrors, and exit liquidity. So, how do you protect yourself, not just your money, but your mindset in this fast-paced and often unpredictable environment? Rule number 1. If it promises guaranteed returns, it's a scam. There is no such thing as risk-free 200% APY in DeFi. The only way to pay that much is by using new investors' money to pay old ones. That's a Ponzi scheme. Always ask yourself, where is this yield actually coming from? If the answer is trading fees or protocol revenue, check the numbers. If daily fees are $10,000, but they're paying out $1 million in rewards, it's unsustainable. And when it collapses, and it will, you'll be left holding worthless tokens. This is a critical point to remember. Rule number 2, anonymous teams are a massive red flag. Remember Squid Game token? The developers vanished with $3.3 million after locking withdrawals. Or Anibistao, which raised $60 million and rug pulled in minutes. These are not isolated incidents. Always check, are the founders public? Do they have LinkedIn profiles, past projects, and reputations to protect? Transparency is key. Has the code been audited by reputable firms like OpenZeppelin, CertiK, or Trail of Bits? Is the audit public, and did they fix the issues found? No team? No audit? No utility? Walk away. These are fundamental checks that can save you from significant losses. Rule number 3, assume every new token is a scam until proven otherwise. Use free tools to verify its legitimacy. On Etherscan, check if liquidity is locked. If not, developers can pull funds anytime. This is a crucial step. On DeFi Llama, see if there's real total value locked, or TVL, or just bots inflating numbers. Real value is paramount. On Twitter, search for user complaints. Can't withdraw, team disappeared, audit fake. Community sentiment is a powerful indicator.
If a project has no community, no transparent roadmap, and no real use case, it's a casino chip, not an investment. Treat it as such.
Rule number 4, diversify beyond price speculation. Instead of chasing the next 100x, focus on infrastructure with staying power.
Consider Bitcoin as digital gold, scarce, decentralized, and battle-tested. Its foundational role is undeniable.
Ethereum as the world computer, powering real applications, NFTs, and stablecoins. Its utility is vast and growing.
Chainlink for secure Oracle data, connecting blockchains to real-world prices. This bridge is crucial for functionality.
These survived multiple crashes because they solve real problems, not because of fleeting hype. They offer genuine solutions.
Rule number 5, secure your assets like your life depends on it. That $500 in altcoins? Don't leave it on an exchange. Move it to a hardware wallet like Ledger or Trezor. Yes, it's less convenient, but the security it offers is unparalleled. But when the next exchange hack hits, and history says it will, you'll be glad you did. Your peace of mind is worth it.
And never, ever share your seed phrase. Not with customer support. Not with our recovery bot. Not even with a trusted friend.
Your seed phrase is your money. Period. Guard it with your life. Now, what about volatility? You can't eliminate it, but you can certainly manage it effectively. Consider dollar cost averaging. Buy small amounts regularly, regardless of price. This strategy smooths out your entry.
Never go all in. Only invest what you can afford to lose completely. This is fundamental risk management.
Use stablecoins as a parking spot. When markets get wild, move to USDC or DI, not cash out entirely. They offer a safe harbor. Because crypto isn't just about getting rich quick. It's about surviving long enough to see the real revolution unfold.
And that revolution might not come from the next meme coin. It might come from something far more boring, but far more powerful.
In Part 3, we'll explore the quiet rise of stablecoins, central bank digital currencies, or CBDCs, and why the future of money might be stable. Thank you for watching. The rise of stablecoins and CBDCs, the boring future of money. Forget moonshots and 100x gains. The real financial revolution in 2025 isn't about volatility, it's about stability. While Bitcoin grabs headlines, stablecoins process over 11 trillion in transactions annually. That's more than Visa or MasterCard, and it's growing fast. What's driving this shift, and why should you care? First, stablecoins solve a real problem. They're digital dollars, pegged one-to-one to the US dollar, moving instantly, globally, 24/7, with near zero fees. A freelancer in Kenya gets paid in USDC, avoiding 10% remittance fees and 5-day bank delays. A trader in Brazil uses DAI to move in and out of positions without slow, expensive banks.
A small business in Vietnam accepts USDT to avoid currency devaluation. This is utility, not speculation.
But not all stablecoins are equal. Tether is backed by a mix of commercial paper and other investments, with limited transparency. USDC is fully backed by cash and short-term US treasuries, audited monthly by top firms.
In a crisis, this difference matters. Remember March 2023? When Silicon Valley Bank collapsed, USDC briefly lost its peg because part of its reserves were stuck there. Trust matters.
Second, regulation is here, favoring transparency. The US is close to passing the Genius Act, requiring stablecoin issuers to be licensed banks or partners.
This eliminates shady operators and boosts trust. The EU's MiCA framework already mandates full reserve disclosure and redemption rights.
The result is a race to the top where safety beats hype. Third, governments are building their own digital money, CBDCs. China's digital yuan is live in over 25 cities, used by 260 million people. The European Central Bank is trialing a digital euro, and the US Federal Reserve has pilot programs with banks. But CBDCs are not crypto. They are centralized, programmable versions of fiat currency controlled by central banks. They could allow governments to freeze your money for suspicious activity without court approval. They could set expiration dates on funds to force spending or track every purchase in real time. Many privacy advocates see CBDCs as a threat to financial freedom. Stablecoins offer a middle path. They are digital, instant, global, backed by real assets, redeemable one-to-one, and in the best cases, transparent and decentralized. The future of money isn't replacing the dollar, but upgrading how it moves, making it faster, cheaper, and more accessible. For everyday users, this means sending money abroad in seconds, not days. It means getting paid the same day you work and earning yield on stablecoins without gambling on altcoins. While Bitcoin fights for store of value status and Ethereum powers the next internet, stablecoins are becoming the rails of the new financial system. But remember, even stable isn't risk-free. Always know what backs your stablecoin and where those reserves are held. Prefer regulated, transparent issuers like Circle over opaque ones. Crypto's future isn't just about rebellion. It's about building something better, within the rules, with real utility, for real people. That's more powerful than any moonshot. If this helped you see crypto in a new light, hit subscribe. We break down money, tech, and the future every week. Thanks for watching.